Hi, welcome to part 3 of my primer on Bitcoin. This primer consists of 4 parts. Part 1 explains what is Bitcoin and how it works. Part 2 covers how cryptology works in Bitcoin and mining. Part 3 takes a look at some major issues of Bitcoin. Part 4 reveals the 9 fallacies of Bitcoin. The links to the 4 parts are in the description box below. Will Bitcoin replace central bank money? Bitcoiners argue central banks are inflating their currencies through decades of irresponsible policies of excessive overprinting. They see the demise of central bank money and the eventual outcome in bankruptcies. This is the forefront narrative being pushed by Bitcoiners. In my opinion, to the point of fear-mongering.
That Bitcoin itself is an existential threat to the central bankers. That's what this was designed. It was designed as an alternative financial system. With Bitcoin, you don't necessarily need a central banker. If you want one, go have a ball. But in the Bitcoin cryptocurrency ecosystem, you don't need those central bankers. Not only that, Bitcoin is an alternative here. So it's the new guard versus the old guard out there, right? So this is kind of like when the newspapers went online. All the newspaper editors said, that's never going to work. New guard, old guard. And then finally, the difference here is what the whole thing about Bitcoin is peer-to-peer. It removes the middleman. And the middleman in this particular case is the BIS and the central bank. So Bitcoin is like the Napster of money. And that's what they don't like about it.
And you see all around you right now, currency wars. What happened in India? They eliminated 2 denominations of currencies. What happened in Cyprus not too long ago? The whole government shut down and took people's money. What happened in the 80s and the 70s in the United States? I believe it was Ohio and Nebraska. They shut down the banks for 25 days and people couldn't get their money. So listen, the money that you have is funny money, to tell you the truth. There's nothing backing it up. There's no gold backing it up. There's no silver backing it up. It's literally numbers that some bank told you is worth something. And at the end of the day, it's not worth anything. So what Bitcoin does for you, it actually gives you, for the first time ever in human history, it gives us a secondary option that is not controlled by the government, is not controlled by the Federal Reserve System. You and I right now can buy Bitcoin.
Are they overselling the utility of Bitcoin? Let's look at some of the issues. They are not listed in any order of importance. You can then form your own opinion. No economics argument for Bitcoin. Bitcoin pitches came initially from the community of cyberpunks who loves the geeky stuff, then libertarians who marvel at the freedom from regulatory controls, the dark web and criminals, and finally the speculators. There has been no economist who has any views that support a Bitcoin monetary system. Economists have fundamental problems with Bitcoin. Existing monetary system is expansionary. Monetary policies of governments have seen money supply increasing over the years. An expansionary money supply is inflationary, because with more money, the purchasing power declines. The value of money depreciates. More money is needed to buy the same stuff that cost less 5 years ago. From an economic standpoint, a slight inflation is desired. Inflation encourages spending. Better to spend than to see the value of money eroded. Spending, or consumption, encourages production. Businesses produce more goods and services, thus more employment and the economy thrives. On the other hand, Bitcoin supply growth rate decreases over time. By 2140 there will be no more new Bitcoins to be mined. Furthermore, people lose their private keys, resulting in Bitcoin lost from circulation. Currently the loss has been suggested at a rate of 1.5% of the maximum 21 million each year. There will come a point when supply of Bitcoins actually shrinks annually. With lesser Bitcoins, and assuming demand remains, then its value will increase over time. This means less Bitcoins can be used to purchase the same stuff compared to 5 years ago. Bitcoin will appreciate with less supply. We say that Bitcoin is deflationary. Economists view this as troubling. Since Bitcoin is going to appreciate, you may wish to hold it. This encourages hoarding, thus less consumption. The lack of consumption is not good for the economy because production is not encouraged. This is the deflationary trap that Japan has been mired in last 3 decades. Bitcoin does not perform 3 economic functions of money. In this respect, it is not money. First, it does not serve as an unit of account. Goods and services are priced at certain amounts in the currencies in use. The cost of a pen is $20. A music lesson is at $50 per hour. And so forth. Nobody is pricing their goods in Bitcoins. They don't, Because nobody knows what the price of Bitcoin is. Vendors accept payments in Bitcoins, but that is not the same as pricing their products or services in Bitcoins. Second, Bitcoin is not a store of value. A store of value basically means you can park your wealth in it, and in some foreseeable future when you needed to use it, you have relatively the same amount of funds. If you have $1 million today and you place it for a 1-year time deposit, when it matures you still have the $1 million. The currency is a store of value. Of course that value is subject to inflation, which is a different matter. Bitcoin's high volatility makes it an unreliable store of value. At best, it is a great speculative asset. Furthermore, Bitcoin is a non-earning asset. You own shares, which earns you dividends. You own houses, which give you rental income. Your $1 million bank deposit earns you interest. These are assets that provide you returns. If you have 1 million Bitcoins, it does not earn you anything. What Bitcoin offers is only capital gains, or losses, as do all other earning assets. Thirdly, there is no mainstream use of Bitcoin in the exchange of goods and services. There is no economics argument for Bitcoin. Bitcoin is an ecological disaster.
Massive blackouts have been hitting in Iran, leaving people there without any electricity. And now, officials are pointing the finger at Bitcoin. Farms require huge amounts of electricity to power the specialized computers. Iranian officials say that's what's straining their power supply. So the government's pulling the plug. According to reports, police have closed down 1,600 Bitcoin centers, even those operating legally.
To do all those computational work in the mining process requires massive hardware. A typical miner's computer room is filled with racks upon racks of devices humming away. The 24x7 operating hours consume massive electricity. The devices get heated up, and further massive electricity is required to cool them. That is the reason miners tend to locate in places where electricity cost is lower and where the outside temperature is cooler. Popular places are in northern China, the Caucasus countries, Iceland, and Scandinavian countries. A recent study by Cambridge University researchers estimated the aggregate Bitcoin miners consume about 122 terawatt-hours of electricity a year. This is insane. It uses much more power than many big economies in the world. It is comparable to the consumption of a big country like Argentina. Bitcoin's power requirement far exceeds numerous economies of first-world countries in the EU. The Economist estimated the next popular cryptocurrency, Ethereum, consumes about 7.5 terawatt-hour a year. You may think this is a fraction of Bitcoin's usage and does not pose a problem. To have a sense of perspective, Ethereum alone consumes more power than the combined consumption of 40 of the countries at the lowest spectrum of world ranking of energy consumption. Mining-based cryptocurrencies have the biggest carbon dioxide footprint in the world. It is ecologically unacceptable when measured against its social benefits. Note that not all cryptocurrencies have the same mining-based methodology as Bitcoin. Some of them are non-mining based, and these do not have huge carbon dioxide footprints like Bitcoin and Ethereum. The problem of scalability. All those talk of Bitcoin becoming a world currency is just hype. Bitcoin is a low-performance transaction processing system. To perform as a world currency, it has to handle hundreds of thousands, or even millions of transactions per second. The truth is, Bitcoin is a sluggish system. And it is a major problem of blockchain technology model based on consensus building. To get a perspective, Bitcoin average transaction size is 380 bytes. With a block size of 1 megabyte, the average number of transactions per block is 2,759. This gives Bitcoin a throughput of only 4.6 transactions per second, or TPS. Compare this to Visa, which handles 150 million transactions daily with a throughput of 1,736 TPS. Bitcoin has a major problem of scalability. Let's look at how Bitcoin can, or cannot, scale to the capacity of Visa's 1,736 TPS. Mathematically, this is straightforward. Bitcoin needs to scale up its transactions per second by 377 times. Current 4.6 TPS multiplied by 377 equals 1,736 TPS. This can be done in 3 ways. 1. By increasing the block size of 1 megabyte to 377 megabytes. by decreasing the block generation time from 10 minutes to 1.6 seconds. Or 3. By a mixture of 1 and 2. To increase the block size requires recoding. The block size is hard-coded and this presents difficulties. To decrease the block generation time, they can reduce the level of difficulty of solving the mathematical problem of finding the target number for the new block. To increase block size, or reduce block generation time, Bitcoin hits a roadblock by something called router time delay. This is the time it takes for a broadcast message to reach all the full nodes in the network. Bitcoin blocks are propagated to more than 10,000 nodes throughout the world. The Karlsruhe Institute of Technology estimated in 2019 that it takes about 14 seconds for blocks to be propagated to 99% of the nodes worldwide. This 14 seconds is the router relay time, or block propagation time. If the block size is increased, the propagation time is also increased. There is of course no data on the dynamics of block size to propagation time. Bitcoin faces roadblock here. The block generation time cannot fall below 99% of the block propagation time. If that happens, then they get into a situation where, before majority of the nodes can receive a new block, another newer block is already generated by another miner. This leads to all sorts of issues of forking, orphan blocks, etc. So assuming the block size remains at 1 megabyte, then the lowest that the block generation time can be reduced to is 14 seconds. 2,759 transactions per block divided by 14 seconds will give Bitcoin a maximum TPS of only 197. Still a far cry from Visa's capability. The challenge of finding a solution to scalability is the nexus of Bitcoin's problem. Some changes have been suggested but there has been no full consensus. As a result, it has led to a situation known as hard forking. This is essentially having Bitcoin Standard split into other versions. Users had to decide which fork to follow. Bitcoin Standard is BTC. Since 2009, hard forks have seen BTC branching into Bitcoin XT, Bitcoin Classic, Bitcoin Unlimited, Bitcoin Cash, and Bitcoin Gold. Each is a cryptocurrency onto its own, some more successful than others. Bitcoin Standard remains the leading crypto. Bitcoin Standard implemented a soft fork in 2017 with SegWit, short form for segregated witness. A soft fork does not result in a splitting off of the blockchain. SegWit is a protocol change that segregated the signature data from the transaction. It works on an opt-in basis. Not all users switch to this. This allowed more transaction in a block. It increased number of transactions in a block 3 to 4 times, which is still insignificant. A current attempt to increase TPS is to use peering on Lightning Network. Basically two parties, or a small group, who deals a lot with each other, can have a sideline peering arrangement where they send and receive over Lightning Network, a separate platform enabler. They only do a netted transaction in Bitcoin. This is complicated and unlikely to succeed. For Bitcoin to scale up to the level of Visa, it's not happening anytime soon. The ambition to be world currency remains a pipe dream. The problem of unregulated privacy. Banking secrecy laws do not permit the opening of numbered accounts. The accounts must be in the name of the owner, whose identity is verified. The banks must know where their customers' deposit funds are coming from. Although Switzerland still allow numbered accounts, they are now required to identify their customers. This is fundamental to tracking the movement of funds through the banking system. Cryptocurrency blockchains such as Bitcoin do not require any identification. The systems do not hold any personal information. This makes them perfect for laundering funds gained from criminal activities, such as dark web market for drugs or other illicit products, and scams, ransomware, hacking, etc., as well as terrorism financing. The cryptocurrency money trail is from one unknown wallet to another. The identity of the recipient can of course be traced when the owner of the wallet cashes out for fiat money from his bank. That is, if the final wallet can be tracked. Laundering cryptocurrencies have developed to a high level of sophistication by the use of mixing algorithms that perform consolidation and fragmentation. Sometimes over a few cycles, and eventually lost in thousands of wallets. The use of peeling techniques add more complexities to the trail. The money trail is obfuscated by washing the funds across several cryptocurrency trades and into thousands of wallets, aided by complicit rogue brokers and exchanges. Chainalysis estimated illicit transactions in 2020 made up only 1% of all cryptocurrency activities. Although small in percentage terms, it was a huge sum of $10 billion. And that was most likely to be on the low end of the estimate due to non-transparency.
Charlie Schramm, 24 years old, arrested today and charged with engaging in money laundering with a user at Silk Road. Now, Deirdre, you recall that Silk Road was that infamous black market drug website, often referred to as essentially the eBay for drugs.
I'm not going to sit here and say I didn't do something wrong. I did. I committed a crime. I took money from people.
Wow. Charlie Schramm, the very founder member of Bitcoin Foundation, is a felon. Can you imagine a central banker who is a felon? In its nascent days, Bitcoin was heavily utilized by Silk Road in the dark web for illicit products and services, primarily in the drug trade. The FBI took down Silk Road in 2013, but that has not stopped the use of cryptocurrencies in the legal drug trade. The biggest dark web group today is the Russian-owned Hydra. Of the $10 billion illicit transfers in 2020, dark web market activity and scams made up the bulk, followed by ransomware a distant third. 2019 was the year of cryptocurrency scams. Plus Tokens was a huge Ponzi scheme that defrauded more than 3 million investors, mostly from China and South Korea. How much was defrauded depends on how one does the valuation. Chinese authorities estimated $3 billion. Chainalysis tracked 180,000 BTC, 6.4 million Ethereum and some other minor cryptocurrencies, were transferred by investors into Plus Token wallets. In total, they estimated $2 billion were lost by investors. The Ponzi scheme operates basically by investors buying Plus Tokens, leaving their funds with the scammers to speculate in cryptocurrencies, from which investors are paid high interests. Scammers then divert the cryptocurrencies and launder them into various private wallets. Plus Tokens was preceded by a similar cryptocurrency Ponzi scheme called BitConnect. This was shut down in 2018 and FBI estimated losses to investors was between $2 to $2.5 billion. But the Ponzi scheme that took the cake was OneCoin in 2017. Investors were defrauded of $4 billion. Cryptocurrency is a perfect fit for payoffs for ransomware. In 2020, ransomware accounted for $350 million. This is very much on the lowest end of estimates as most victims do not report it. However, it represented a hefty 311% increase over 2019. The reason is most likely a higher volume of work done at home, due to the pandemic, prompted more work done online and thus higher exposures to ransomware attacks. Privacy protocols of cryptocurrencies is the one single reason why Bitcoin will never be a world currency. What gives Bitcoin value? Simple economics of supply and demand. With high demand and low supply, prices increase. Simplest trick in the entrepreneur's book. Create demand, whether by hype or real utility, fashion, fear, prestige, novelty, and so on. Then limit the supply. And prices have only one way to go. The Rothschild family mastered this trick long ago. De Beers Group bought off raw and uncut diamonds and kept them out of the market. They created artificial scarcity. And their diamonds became women's expensive best friends. That's the physical world phenomenon. Now, Satoshi has done what no one could do before. Digital scarcity. He has done on the internet what De Beers does in the physical world. Bitcoin supply is capped at 21 million by 2140. As miners' rewards get halved every 4 years, new bitcoins coming into the market are getting lesser. Bitcoin pundits like to compare to gold. Like gold, so they say, Bitcoin supply is limited. What Bitcoiners don't say is, gold scarcity is real, Bitcoin scarcity is artificial. As at June 2020, total Bitcoins issued was 18.6 million. According to Chainalysis, 61% of these are held by investors who hold onto them for many years. 20% are estimated to have been lost as they have not been moved for many years. Only 19% or a mere 3.5 million Bitcoins are actively traded. Bitcoin is a very illiquid market. The scarcity of Bitcoins can only exacerbate. Currently, New 6.25 bitcoins are mined per block. This means 325,800 new bitcoins, or about 1.6% of the max 21 million, are currently issued per year. Bitcoins lost per year is about 1.5% of the max quantity. With new bitcoins per block reduced by 50% every 4 years, this means very soon, there will be negative bitcoins each year. On the demand side, Bitcoin has been hyped like crazy. Interest in bitcoins started with the cyberpunks, then the dark web and those dealing in nefarious activities, followed by the smart money techie guys and the libertarians. All these are primarily retail players. Then came the speculators who hyped up the market. With growing acceptance as an asset class, serious institutional investors are beginning to see bitcoins as a hedge for current macroeconomic uncertainties, driven in large part by the excessive expansion of fiat currencies, especially during the COVID-19 pandemic. Institutional investors that include hedge funds, bring serious money into the game. All these became evident towards the end of 2019, and prices exploded in Q4 of 2020. The data bears this out. In 2020, although there were tens of millions of Bitcoin holders, only 340,000 were active on a weekly basis. Retail transactions, that is, those less than $10,000 each, accounted for 97% of total transactions. Institutional transactions accounted for only 3%. However, value-wise, retail transactions aggregated only 15% of total value transacted. The larger transactions of institutional players accounted for 85% of aggregate value transacted. The big money and herd instincts of institutional money beckons. The market is poised for astronomical heights, as most pundits predict. The news whizzing by just adds to the hype. Will Bitcoin hit $400,000? Is it a bubble or is there real value? Let's take a breather, and see some spooky similarities between Bitcoin and tulip mania. First, the wealth background. Tulip mania was the world's first economic bubble. Tulip was indigenous to Turkey. During the Ottoman Empire, tulips were high society ostentatious display items. Dutch diplomats introduced the flower into Holland in early 1630s. The people took to the flowers and its popularity grew. People soon realized that tulips could be flipped the next day with quick profits. Speculation grew. Holland was in its golden age and the Dutch were advanced in commerce at the time. With great wealth came investment fever. To a good extent, the world today is extremely liquid. Massive expansion of fiat currencies by most governments have seen great wealth built up from skyrocketing asset valuations. Too much wealth have been chasing lower and lower yield curve. Bitcoin is now seen as a great investment opportunity. Second, control of supply. The Dutch soon started planting their own tulips in Holland. To prevent oversupply, traders had contract clauses that prevented buyers from replanting. Thus physical scarcity was managed and prices rose. Bitcoin has digital scarcity assured in its codes. Third, futures trading. Amsterdam had the first futures trading in the world in 1637. With derivatives trading and no need for physical tulips, prices hit the roof. The U.S. had Bitcoin futures on the exchanges in Chicago in 2017, and prices exploded in that year. Fourth, fatalistic speculative mentality. In the 1630s, Europe was in the grip of the plague. The strenuous situation nurtured a fatalistic mentality to investing. In our current time, we have the COVID-19 pandemic. Lastly, the price chart. Look at the tulip price chart and the Bitcoin chart. They are eerily similar. Bitcoin is now $50,000. Will it hit $400,000? Tulip mania may offer some perspective. At its wild height in 1637, the price of tulip was the equivalent to today's value of $500,000. A good way to explain Bitcoin holders may end up with nothing is the Shuk al-Marnouk crisis in 1982. That was the crash of the stock exchange of Kuwait. Post-oil price shocks of the 1970s, Kuwaiti elites had money flowing out their ears. They had to invest somewhere. The local stock exchange was the hottest place in town. One big problem. They only had a handful of listed companies and market capitalization was low. One obvious solution. A mad rush to list companies on the exchange. Soon, many listed entities appeared which had practically nothing except a business plaque somewhere. Unregulated pre-sales practice caused a huge complex web of cross-indebtedness. When the market collapsed, that took years for the debts to be sorted out. Those who had holdings in empty shell companies ended up with nothing. The share certificates represented nothing. In the same way, holdings in bitcoins are as good as the shares in those Kuwaiti shell companies. They represent nothing. Now, many still wonder, what is it that one actually holds in Bitcoin? Bitcoin players have now come to terms that the crypto is not really a medium of exchange. It is now relegated to an asset class. Now with various asset classes, one appreciates what the ownership is all about. It may be tangible and physical assets like a house, shares in companies, cars etc. The ownership is easy to understand. You can use it and revenues that can be derived accrues to you. It can be intangible like patents which you can sell or license them out. It can be some financial derivative contracts such as options, in which case you have claims to some future cash flows. In the case of cash on hand, the currency notes and coins, you have claims on the government. In the case of bank deposits, you have claims on the banks. Similarly as with most securities, you have claims on the issuers. Bitcoin is none of these. You have claims to nothing. Bitcoin has value as long as people are willing to attribute value to it and willing to buy from you. Some final thoughts. After the completion of these 4 parts, I delayed the publication to attend to some other matters. Since then, some significant events have taken place. Bitcoin prices had dropped by 50% to $30,000 level. This volatility that has no economic causation, just goes to demonstrate its unreliability as a store of value. The malware attack in May 2021 on Colonial Pipeline created a gas crisis in the U.S. The ransom was paid with bitcoins. Whilst it was not an actual attack on infrastructure, but on the company's server, it has certainly raised further awareness of cryptos as a national threat. The U.S. Department of Justice is now treating ransomware at the same level as terrorism. On June 23, 2021, the story broke about the problems at AfriCrypt, a crypto investment company in South Africa. Raiz and Amir KG, the founders of the company, disappeared together with their customers' bitcoins. Some BTC 69,000 went missing. How much was lost in dollar terms depends on when it is valued. The loss seemed to have occurred sometime in April 2021. Let's say the average price at the time was about $50,000, that would work out to $3.5 billion. Certainly the biggest scam in world history. The KG brothers were in their late teens when they started AfriCrypt in 2019. It's beyond incredible that investors do not trust bankers, but will put their money with a couple of teenagers. How is it possible a firm with not history behind it can pull in so much funds to manage within a couple of years? In the past 2 weeks, China has ordered the shutdown of cryptocurrency mining operations. Operators are exiting China in droves and rushing to restart in other countries. China has actually made it known in 2018 that they want to see an organized exit of miners. The reasons were thought to be the excessive energy consumption. But it has also been explained as an official act to curtail frauds and money laundering. China's shutdown of miners has seen hashing rates or computation capacity drop drastically, by as much as almost 50%. The bulk of miners are in China, Russia, and Iran. The geopolitical risks aspect has not been a narrative previously. But this Chinese miners shutdown could have certainly raised new concerns going forward. The drastic drop of hashing rates exposes Bitcoin to a higher risk of 51% attacks. Binance is under investigation by the U.S. Department of Justice for money laundering and tax evasion. Binance is the largest crypto exchange in the world with daily turnover of about $46 billion. This puts its stablecoin BUSD at risk. On June 17, 2021, investors experienced the first crypto collapse. Titan plunged from $65 to almost zero in one day, wiping out its market capitalization of about $60 billion. Even billionaire crypto investor, Mark Cuban, who had been hyping up Titan, suffered colossal losses. Titan is a DeFi token of the stablecoin Iron. Nobody knows what happened, but it seems a coding error in Iron's redemption algorithm is the cause. The Colonial Pipeline hack, the AfriCrypt scam, the shutdown of Chinese miners, Binance investigation, and collapse of Titan, all coming in at about the same time frame, have certainly heightened the concerns of all governments on the threats and risks of cryptocurrencies. It is not a nice picture, and does not augur well for the future of the industry. One seemingly positive talking point for Bitcoiners is El Salvador. It has made Bitcoin legal tender. It's a big deal for Bitcoin. The first country to pioneer a nationwide use of a crypto. It seems like a breakthrough big deal, however, champagne glasses are premature because 1. Some industry experts, who looked through the details of the legislation, said it looked like a state scam that will translate to appropriation of US dollar. 2. The mechanism to implement this has still to be worked out. The project proponent is 26-year-old Jack Mayers, CEO of a new crypto payment platform called Strike. Crypto payment platform is nothing revolutionary. However, Strike is based on Bitstream Lightning Network, which is supposedly faster and cheaper. Strike is tied to Tether, the stablecoin which is currently suspected to be in survival mode. If Tether collapses, the economy of El Salvador falls. But Mayers has said, after speaking with President Nayib Bukele, Strike will work on Bitcoin Lightning Network. Mayers, running a company with 13 employees, will integrate Strike with 5 Salvadoran banks. Details are not out. But it is hard to see how Mayers can scale up Bitcoin for microtransactions, even using the Lightning Network. Similarly, if Bitcoin collapses, El Salvador economy falls. I shall end this with a cliffhanger. Will Tether collapse and bring Bitcoin down with it? There is already one hint. The huge plunge of Bitcoin price in May 2021 was due to developments at Tether. I will dedicate a separate video on Tether. It may perhaps explain the scam in the whole crypto marketplace and possibly the reason for the almost total shutdown of miners in China. Make sure you subscribe so you can be notified of the Tether video. Thanks for watching the video. I have a favor to ask. I need to build subscriber base in order to monetize my effort here. So if you find the video useful, please subscribe and like and share with your friends by clicking the YouTube buttons below. Thanks a lot.